Your investment performance is a collection of periodic returns through time. Let that sink in for a second. This means that if you, like everyone else, are looking to maximize your investment returns, you shouldn't be looking to just spend time in the market, but should be extremely interested in strategies that allow your investment portfolio to average up over time. But here is where the problem lies. While the S&P 500 had an undoubtedly phenomenal year last year, posting total returns of 26.3% in 2023, you need to think of that number in the context of what happened the year before. In 2022, the S&P 500 returned an 18.1% loss.
Please, sir, I want some more.
I can't help but think that there must be a better alternative than earning 3.4% per year. Here's a chart that compares the 1-year, 3-year, and 5-year performance of ATRFX against the S&P 500 index and the classic 60/40 portfolio. It shows just how ATRFX is able to maximize returns by allowing investors to average up. And from this single chart, you can clearly see why ATRFX won the Lipper Award for being one of the best performing funds in total return terms, all the while growing its assets under management from just over $2 million to over $350 million, signaling growing investor interest. But let's take a step back for a second. ATRFX is able to closely match the S&P 500 when the market is up, like what happened in 2023, and outperform the market when the market is down, such as what happened when the broader market crashed in 2022. Passive investment funds seem to be gaining quite a lot of traction lately, as investors shy away from actively managed funds and strategies with relatively high expense ratios. But there are cases where the expense ratios appear justified. Fund total returns take into account a fund's expense ratio, meaning that the number that you see is the total return value after all deductions and expenses have been made. ATRFX might have a lofty expense ratio of 1.77%, but that's a result of the daily rebalancing and the fees accrued from its strategy. It's not a reflection of the quality of the strategies. Despite the expense ratio, ATRFX's 3-year and 5-year total returns still managed to outperform the S&P 500 by a wide margin.
Let's not talk about my margins, by the way.
$10,000 invested in the S&P 500 between 2021 and 2023 would have grown to around $13,300. The same amount invested in ATRFX over the same time period would have grown to nearly $15,000. As I said at the start of the video, your investment performance is a collection of periodic returns through time. You will be rewarded for time in the market, but if you want an extra reward, consider how you can average your investment portfolio up. ATRFX is an easy way to do that.